Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. Thank you very much for joining us this afternoon. We are hosting, we were going to be hosting Vlad Karpel this afternoon, but he had a last-minute situation, so Keith Harwood has actually stepped in to join us this afternoon and take over the presentation. We're thrilled to have him here. He's going to be talking with you all about option call spreads and going into detail about this strategy. Keith, are you with us?
I am. Yeah, thank you for having me. And yeah, happy to fill in with Vlad unavailable today. And hopefully everybody enjoys my version of the presentation this week. And, we'll have Vlad back here soon. So,
Yeah, absolutely. Thank you so much for stepping in, and thank you to everyone who signed up and who is with us in the Zoom room live. You can go ahead and take control of the screen when you are ready. And I'll just remind everyone with us in the Zoom room, if you have questions during the presentation this afternoon, please go ahead and type those questions into the chat or the Q&A, and I'll get those to Keith to address, time permitting. All right, Keith, I can see it. So you take it away with lunchtime options trading when you are ready.
absolutely. So, yeah, again, I'm Keith Harwood here. We're going to be talking about unlocking option spread potential today, and going through that particular option strategy as a way to potentially help leverage returns as well as defining risk and everything else that is beneficial, I think, with options. Pictured here, you got me as well as Vlad. So before we get started, I'll do a little background on myself. So I started my career in the option pits of the CBOE back in 2005. So about 20 years ago, I traded through the subprime crisis and all sorts of good stuff since then, infinite quantitative easing and everything else. But I was a market maker on the floor. So I was making markets in a few hundred different equity options, and decided after the subprime crisis that I wanted to go and try to pursue something a little bit different within that space outside of the market making. So got a great understanding of options, all of the minutia about options trading. Worked over to trading as a proprietary trader, and a hedge fund trader for a CTA, commodity-based hedge fund. So in that, I learned a lot more about technical trading. After I decided not to continue with the hedge fund side, I decided I wanted to get into the educational side of things and work with individuals on understanding options and how best to potentially leverage their trading ideas. I joined Option Hotline as the chief option strategist in 2018 and partnered up with Vlad last year in 2024 to share my expertise in options, equities, fixed income, and commodities trading. Um, I also have a little blurb here on Vlad, just as a reminder for those that are not as familiar with Vlad, or if this is your first time, welcome. Vlad is the founder of Yellow Tunnel, and his background a little different from mine, a little bit more technology focused. He was the executive vice president and head of technology for Options Express from their inception through 2007. He's also been a CTO of Mediation and consultant to investor and early stage financial technology companies. So he's got a lot more technology background, really brilliant mind in terms of artificial intelligence, technology advances, and the applications to trading. And I think that's where our synergies work really well. He's got his 25 years of trading experience. I'm 20 myself. We've both been in the educational space. He builds these amazing quantitative models and programming, and I bring in my options background, my understanding of market dynamics from being a market maker, and hopefully that brings together something that can be that much more powerful from the educational space and a couple of different perspectives with the same goal in mind. Now, before we start talking about spreads themselves, disclosures. I'll give you guys a moment here to read through the disclosures. Key here, options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself, not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, I recommend you reach out to a registered financial advisor, such as AGT here. They can answer a lot more questions for you than I can because of the registration requirements. And again, this information is for education and information purposes only and should not be taken as trading advice. And if we have any conversations about any specific ideas, please do also keep in mind that at times myself and or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. All right. Hopefully that gave you guys all enough time to go through those disclosures, and now we'll start talking a bit about trading itself because that's why we're here, right? So there's a number of common obstacles within the trading world. And before I get into this too much more, again, if you do have questions, feel free to throw those into that chat box or the Q&A box, and I'll try to address them as we go through, or we can address them at the end. But one of the things that people often look for when they're trading is not just how to generate a return, but how to leverage the capital that they've got. So if I'm considering an investment in SPY, the S&P 500 ETF, it's currently trading around $668. So if I buy 100 shares, that's going to cost me $66,800. If I want to try to get a bigger return on my portfolio with either using less capital or using the same amount of capital, I have to figure out a way to do that. And there's, all sorts of options for people. They can margin their account. They can take a loan effectively, which is what margin is, or you can go into the options market and leverage the returns, but modifying, of course, the risk reward structure in the process. So options do give a great source of how to leverage that capital, but also help define the risk. Um, Another obstacle that a lot of people tend to have a difficult time with is how to properly manage and adjust positions. And give you an example of what's been going on here in this week. Um, you have a stock or the last few weeks like IONQ. Many of you may have caught this one. It's a quantum computing company, and it basically doubled or something close to that in stock price. Now, how do I manage that? Am I selling it along the way up? Am I selling it once it starts coming back down? Unlikely to be able to sell the top, but how do I manage the psychological aspects of selling into the rally, selling once I feel like the rally has reached its apex, or how do I adjust these positions as I go along? And if I'm making the trade with options, it can be that much more difficult because sometimes you have these stocks that run up and then run right back down, and I can turn a winning trade into a loss really quickly, and be very frustrated with that. So. Um, some of the benefits of the strategy we're going to be talking about today is that it has kind of an embedded management and adjustment point for a position. And that can actually be beneficial to a lot of traders in that there's almost a need to adjust once the profit is achieved, because now the risk reward profile shifts drastically in such a way that I don't necessarily want to maintain the current position. And that keeps me active with it and helps me book profits and or adjust in case of a loss. Um, Another very common obstacle, of course, is the impatience and short-term focus. So, I was talking about this with some people this morning. I've been personally looking for a potential short opportunity within precious metals. Now, if I go a very short-term focus in, say, silver, I may look for options that expire tomorrow as a trading opportunity. Now, that's a very short-term trade, and I have to time it perfectly. But that's where you can almost see these massive potential 1,000, 2,000% returns. They're unlikely to hit. So when I see an opportunity with something like 1,000 or 2,000% return possibility, it means that the odds of it actually occurring are very, very low. So I have to start maintaining this concept that I give myself a little bit more patience, add a bit more time to my trade to play out, and then I can still be within the trade if the is later than I expected. And if it happens to occur sooner, so be it. Maybe I didn't generate a 2,000%. Maybe I only got 100% return and I still had a very nice win, but I didn't have losses along the way trying to achieve this lottery ticket like type return that's just not a realistic long-term growth strategy for an account. Um, and then as we continue on, the concept of speculating, which tends to have a short-term trading opportunity versus managing like a larger portfolio. These are other things that can become an issue for people in their trading. Looking at a stock for a short-term opportunity and then ending up turning it into a long-term holding for whatever reason, whether it's because the stock went against me and I don't want to take the loss, if I was just taking a short-term speculative position and then I end up holding it for months or years just trying to get back to a break even, now I'm managing a trade that was never intended to be an investment, but it's completely shifted because I didn't have the right trading plan, which is our final point, bullet point here. And then, of course, chasing the market when something is going one way and saying, I just want to get on board. Well, if I don't believe in that trade, then why would I chase the market just to try to generate a return? I have to have a plan around it. And again, that comes back to this whole trading plan concept. And with the call verticals using that we're going to talk about today, a bull call spread, it helps me generate a trading plan around the trading strategy. So before we get into how that actually works together, let's talk about what we're going to be looking at today, frankly. So it's process behind different types of options trades can be a bit difficult at times. So we're going to focus on the bull call spread today. The bear call spread is basically the mirror image of a bull call spread. A bull put spread is a credit put spread, which has the same general payout as a bull debit call spread, and a bearish put spread, i.e., a debit put spread, buying the put spread has the same general payout as a bearish call spread. But we're going to focus on the bullish call spread. And if you're looking for how that would correlate to a bullish put spread or a bearish put spread or a bearish call spread, I can always touch on that as we go through. So a bullish call spread, just generally speaking, is a bullish strategy. And the idea is that I have to have a feeling that an asset is going to have a positive upward move. And I'm not talking about those parabolic moves where a stock's looking to go up 100%. I'm looking for a general bullish bias. Maybe that's my general bias for the S&P 500 right now. It's a drifting higher strategy. It's a lower risk, a lower reward. It's not going to generally pay out if S&P 500 goes up 50% in the next week, but how likely is that? Almost nil. It gives some good upside potential in exchange for the chance to recover some premium because it's a cheaper strategy than a long call. If I buy a long call or to have unlimited upside, if I buy a call vertical, I'm capping my upside in exchange for a lower cost. Now, the actual strategy itself is set up this way. I buy an in the money or sometimes at the money call option. Now, in the money means that the strike price is lower than the current price. At the money would be around the current price. And remember, the strike on an option is the price that I have the right but not the obligation to buy the stock on or before the expiration date. So a good example would be the October 17th 660 call in SPY. That gives me the right but not the obligation to buy SPY for $660 per share prior to October 17th. That's an in the money call because SPY is trading 668. A 670 call is out of the money. It's higher than the current price of SPY. If SPY doesn't go anywhere in the next, 2 weeks and a day, the 660 call has value. The 670 call does not. That means the 660 call, again, is in the money. The 670 call is not. The 670 call gives me the right but not the obligation to buy the stock for $670 per share on or before October 17th. So if we rally significantly over the next 2.5 weeks, that out of the money call becomes in the money call and generates a nice leveraged return. The in the money call goes further in the money and generates a nice leveraged return relative to stock. We use the same underlying asset, the same expiration time when setting up a bullish call spread. That helps keep it simple. There are strategies that use different expiration times for the options, not different assets, but different expiration times. Today focuses same expiration time, one call that's in the money that I would buy, one call that's out of the money that I would sell, and as such, reduce the premium I'm paying for the total package. Now, in order to trade these options, you got to obviously know some of this terminology, and I touched on that a bit, especially with regards to the strike price. That's the price, again, that the underlying stock can be purchased or sold. So the $660 call gives me the right but not the obligation to buy the stock for $660 a share. The 660 put gives me the right but not the obligation to sell the stock for $660 per share. So my ideal when I'm buying a call is that the stock price either has to go above or go further above the strike in order for me to exercise it for a profit. At the very least, the $660 call will be worth the difference between the strike and the current price of the asset. So SPY trading 668, the 660 call has to be worth at least $8. Otherwise, it's an arbitrage opportunity, and there are many computer programs out there that fix those arbitrage opportunities. Because if I could pay $6 for the 660 call when SPY is trading 668, I just turn around and buy as many as I can for $6, exercise them, and sell out SPY for 668 and net $2. So that arbitrage doesn't last. So don't look for the arbitrage opportunity. Computers fix that if and when it ever exists, which is rare these days. But I know at least a minimum value for that call when I'm first starting. And I'm always going to be paying, almost always going to be paying something more than that. So I do need to have price appreciation, even if I'm buying an in the money call. Now, once I set it up with selling it out of the money call, I may not need much, if any, price appreciation. So I buy this in the money call at a lower strike. Again, 660 for SPY is in my example right now. And I sell that out of the money 670 call. And then the payout looks generally like this. We don't have the specific numbers here. We'll have those on a later slide. But if the stock goes to or through my short call strike price, that is my max gain. If it goes to or through my long call strike price, that's my max loss. I lose the premium paid here. I lose or I profit here by the difference in the strikes minus the initial premium paid. And anywhere in between, it's this linear function dependent upon the stock price. All right. So generally speaking, the way that we've set it up here with buying it in the money call and selling it out of the money call, the break even point is around the midpoint between those two strikes if you make it relatively symmetrical. If it's asymmetric, again, if SPY is trading 665, the 660, 670 call spread is symmetrical. If SPY is trading 668 or 669, it's a little bit asymmetrical. I'm going to have a little bit more risk than reward potential. This example graph here is much more of a symmetrical setup where I'm buying a call that is as far in the money as the call I'm selling is out of the money. $5 in the money for the call, $5 out of the money for the short call. Now, when I'm going through these strategies, one of the big things is, of course, not just calculating the potential loss, which is simple, that's the premium paid, but calculating the maximum profits for the trade. And I touched on this a moment ago. The profit potential is the difference between the strike price and the initial trading cost, because the maximum value of a call vertical, a call debit spread, is the difference between the strikes. So the maximum value of a 660, 670 call spread is $10. If I initially pay $5 for that, that means my maximum profit is the maximum value, $10 minus my initial cost of $5. So my max profit's $5. My max loss is the premium paid, $5, and it's a symmetrical setup. If the prices move higher, any losses that I incur from the sold call gets deducted from the gains from the purchased call. And there are many times where the short call goes down in value, even though the long call has gone up in value. Imagine a scenario at expiration, we're trading 669. The 660 call may have increased in value, but the 670 call is worth nothing. So that's the optimal scenario when I've got a situation where we go to my short strike or just a little bit through it. Then that tells me I leveraged this almost perfectly and really pinpointed my strike. But the general goal again here is we want to see appreciation in price to or through the upper strike of a call vertical. So how do we determine this? Well, one of the things that we do at Yellow Tunnel is we use this beautiful artificial intelligence system. Vlad built this artificial intelligence system using neural networks and all of this other really fancy technology stuff that I could never build, but I can use because it's intuitive. It tells me what artificial intelligence predicts for potential stock movement over the short, medium, and long term. So this AI takes all the data from open, low, high, close, volume, earnings, and other inputs and fits a model to the stock and says, okay, well, based upon the money flow that we're seeing in the general stock market, the money flow we're seeing in this individual trade, and the correlations to other similar assets, what model fits best for the near term? And it spits out an AI analysis that I can then combine with my own personal bias and say, okay, well, if I'm really bullish in JP Morgan and I want to hold this position for 1 month, well, right now, the trend may say that over the course of the next month, we actually have a little bit of a dip. So maybe not fit my thesis, but over the next 10 days, maybe it looks a little bit bullish. And this was from a few days ago. So the model may have adjusted given that JP Morgan and a number of other financials had a little bit of weakness in the last 2 days over the government shutdown. But, at the time of the evaluation, we look and say JP Morgan's trading around $316. It looks like it can go higher over the next 10 days. I can set up a call debit spread that expires in 10 or 15 days to potentially try to achieve that return. And if my price target was, for example, here 318, the predicted high of that particular trading session, then I would be looking to buy, something like a 310, 317 and a half call vertical, maybe a 310, 320, something that would appreciate in price on a move to 318. It didn't need JP Morgan to go to 350 to make money, but the call vertical can make money on just a simple price appreciation of a dollar or two if structured correctly. Now, we'll go back to this SPY idea because this one is one we've been discussing, and there's a lot of elements behind that that need to be understood when going into a call vertical. First off, what's the probability of any profit? Well, the nice thing about this, once you've actually identified the idea, just off of pure standard deviations, not about predictability from AI or anything like that, or predicted price movement. It's just off of, the simple math, assuming a relatively normal curve, et cetera, et cetera. The probability of the profit of this call spread when SPY was trading 661.84 was 42.7%. Because at the time, the 660, 670 call vertical expiring on October 17th was trading for $5.48. And the current price of SPY was 661.84. If SPY didn't move for the next 3 weeks, in this case, we had 21 days to expiration when grabbing this screenshot, that call vertical would be worth $1.84. So it would have been a losing trade without movement. With movement that we've already achieved, this call vertical is now trading a little bit over $7. And the probability of profit is significantly higher. If we expire at 668 in 15 days, the profit will be achieved and it'll be trading for $8 if we're 668. And that's a nice $2.50 profit on an initial investment of $5.48. A lot of other analysis can go into this, but the key understanding here is that we've got the 548 of risk, as we identified before. And that means the max profit is 452,000, or it's 10 minus 548. And that's listed here. And I should note for those that have not done a lot of options, the deliverable on an options contract, a traditional options contract, is 100 shares. So for every one call that I own, I don't have the right to buy one share. I have the right to buy 100 shares. So when you see something that's trading for $5.48, that really means $548. Got to multiply it by 100. Okay. And that's what we're seeing here. The max profit is the $452. The max loss is $548 per one contract of the call vertical. The debit as a percentage of the difference, 54.8%, 548 divided by 10. The max profit, 82.48%. That's 452 divided by 548. The risk to reward is just the ratio there. 20% more risk than potential reward. The probability of maximizing my profit is about 1 in 3, and the probability of achieving my max loss is close to 50-50 at the time of entry because we were trading right by that entry price for the long strike. It creates a nice setup, though, when you get into a good call spread here, because now if the market rallies to 670 or 675, and my call vertical is trading for $8.50 or $9, the risk reward may no longer be there. And it kind of forces me to go through and say, I'd like to reevaluate my position. I've gotten a nice win here. Maybe I've made $3 per contract on the call vertical, more than 50% return. And I'd like to reevaluate whether that's the right structure right now. So now I'm almost forcing myself to book my profit and start over with a new position. And that's part of that trading plan concept. If I know I'm going to be looking to book profits at 670 or at 675, then buying a long call may not really give me much benefit. I mean, in this example, particularly, if 670 was my target If I just bought the 660 call for $9.73 and we get to 670 and that's all we do by October 17th, I'm going to make a whopping 27 cents. It's not bad, 2.5%. It's not good, 2.5%. It's, market's up 1.5% and I made 2.5%. That's not the real leverage that people are normally looking for in the market, the options market. But buying a call vertical for $5.48, I have a possibility of profiting 82.5%. So an extra 80% just from selling that 670 call. So once I know my general game plan, my general price target, and everything else, I can actually structure a really nice call vertical as opposed to just buying a call or buying the stock to really leverage my profits. And that's a huge thing with bull call spreads. Now, we have a couple minutes here for questions, but while I'm waiting to see if you guys have a couple of other questions, I do want to note if the counter to this would be like a bear call spread, and it would be a mirror image of this. So I would sell this call vertical for 548. Now my profits are where I see the losses here, and I just take a mirror image. And then on the downside, I'm hoping to make $5.48, the premium collected. And if we run up, my max loss is now $452. And in that scenario, I'm selling the in the money call and buying the out of the money call. So for those looking for the bearish version of that, it's just 100% the mirror image of this, and then everything else would follow along with that. You just take the inverse of all of these numbers and all of these charts, and that will give you the imagery of how that pays out. All right. All right. Um, I've got Vlad's contact information up on here because he's going to be sending you guys a free gift. So in your inbox, you're going to get an email from Vlad at yellowtunnel.com. You can email Vlad at yellowtunnel.com. You can also reach me, Keith at yellowtunnel.com. You can go to our site, yellowtunnel.com. We have contact forms there as well. Here's a phone number you can reach us at. So all sorts of ways to reach out if you do have questions about call spreads or anything else regarding trading or the Yellow Tunnel services. We're really happy to discuss them with all of you. So I hope you guys all got some good information here about bullish call verticals and how to apply them. And if there's anything I can do to help you guys out with the implementation of this or any other strategy, always feel free to reach out because we can work through that and help you guys out with the educational side of options trading.
Thank you so much, Keith. I'm going to ask you to leave that screen up just for a minute so everyone can write down the contact information to reach out. You know the drill. People will come up with questions later in the day, 6 days from now, they'll pop into their head. So just a reminder to everyone, please write down this info and reach out to Keith and Vlad if you have specific questions about the presentation this afternoon. Thanks again. We did just get a question coming in. What about bull put credit spreads?
Okay, yeah. So a bullish put credit spread. Let me see if I can pull this back up here, go back to the charts. So an example of a bullish put credit spread would be effectively instead of buying the 660 in the money call and selling the 670 out of the money call, a similar strategy would be if I wanted to be around the current price, I could sell the 670 put and buy the 660 put. So now I'm selling the in the money put and buying the out of the money put. That's going to have almost to the penny the exact same payout as buying the 660 call and selling the 670 call. In practice, a lot of times we use out of the money put credit spreads though. And that's going to have a similar setup, except for that the profit is going to be lower. It's going to be shifted to the left and lower. Like if I sell the 660 put and buy the 650 put, my profit window begins somewhere probably around 658 and a half, but it peaks out probably somewhere around $150 to $200, and my risk may be about $750 or $800. So if my profit potential is 250, for example, my risk would be 750. So a lot of times people put up an asymmetric setup there saying, I don't think the market's going to go down, but I'm not sure if it's going to go up. And that's where I tend to look for a put credit spread in those scenarios. When I have the directional bias towards the upside, I like to buy the in the money call and sell the out of the money call. If I'm using two strikes that would both be in the money on the call side, I get better execution by selling a put credit spread, selling a 660 put that's slightly out of the money and buying a 650 put, which is more than anything to cap my loss and reduce the capital needed for that trade. And defining risk is always an important element of trading.
Great. Thank you so much, Keith. And thanks for that question, Chuck. Last minute questions. Now's the time. Oh, you're welcome, Chuck. All right. I think we have wrapped it up here on our segment of lunchtime options trading. It was kind of nice and quick, some good free education, a lot of good questions answered. Thank you for that. I'm going to go ahead and take the screen back just for a moment, just to remind everybody to check out avantgardetrading.com. You can get there by typing tradeagt.com as well. We are running an offer. You can open a brokerage account and start trading through the end of the year and get commissions and membership pricing for free through the end of the year. So definitely check that out. Head to our site, give our team a call, 312-858-5748, and get some more information. And please do join us for our next free educational webinars. We have one coming up on the 14th with the OIC, so sign up for that and reach back out. And we will see you all soon. Thank you again, and good trading to everybody.